Today we will be discussing the strategic business decisions that were made for the Fresh Springs Water Company. I'm Marcy Moran, the CEO. The CFO is NM, and potential investor and creditor is Will. As an overview for the Fresh Springs business, this is a retail beverage company that is a water bottle distributor. The revenues forecasted for 2021 are $35,000, and the net income forecasted is $22,000. For business outlook plans, there is current maximum capacity at the current geographic region. The goal would be to expand to another geographic region to increase sales. The spring water growth is expected to be about 2 to 7% annually. Another goal would be to explore reducing plastics in the water bottles. The first strategic decision involves the purchase of an asset. The three options are purchasing $3,000 of inventory, renting a factory for $12,000, and paying $6,000 to a contractor to build a website. The first option of $3,000 of inventory would increase the potential for sales. However, Fresh Springs is already at maximum capacity for that geographic region and is looking to expand to increase sales. It is hard to take on more merchandise inventory right now and may not be beneficial as we are at maximum capacity where we are. There is also a significant amount of inventory currently in the company, $22,500 worth, and there is a low cash balance remaining, $3,000. This cash can be used better elsewhere to grow the company. The second option, to rent a factory, lines up well with the goals of the company, as renting a factory in another geographic area will expand the company and work well with the water sourcing located in the distant state. This has lots of room for potential growth, and the first step to expand any business is to acquire the factory before receiving inventory. The money can be obtained with a $50,000 loan discussed later on. For the third option, updating a website is helpful for reaching the market in a new geographic region. However, this is not the best option for Fresh Springs for two reasons. One being that water bottle sales are not usually based on a good website, as they are usually bought in stores, and marketing and outreach costs are better spent on packaging, shelving space in stores, and other retail-related endeavors. The other reason is that Fresh Springs isn't ready for marketing yet, as they are maxed out in the current region and don't have manufacturing yet in a new region.
How will buying a $12,000 building affect our company's accounting equation? Well, it will increase our assets and increase our liabilities, but have no effect on our equity. By the decrease of the $12,000 in our cash, it reduces our working capital for 2022 by that $12,000, but also an additional $400 per year from the depreciation with a useful life of 30 years, all based on estimations. That depreciation will affect our net income, but not the assets that we just bought, the building asset. So our net income comes out to decreasing by $400 each year. When looking at that in the grand scheme of things, it leaves us with less working capital, less money to use in the now, but it doesn't really affect our net income that much.
The second strategic decision involves assuming a liability. The two options are to take out a $50,000 loan with $60,000 due in 3 years, and the second option is a $50,000 loan due in 4 years with $2,000 in interest each year. The first option would entail that the company needs to pay back $10,000 in interest on top of the cost of the loan at the end of 3 years. While this loan is more costly than the second option in the long run, the short-term benefit of having the full $50,000 for 3 years is a good option for Fresh Springs, since we need time to invest in the new geographic location and start our sales up. With a net revenue of $22,000 per year, this should be easily able to be paid back, including the revenue that will be obtained from the new factory built. The second option requires the company to pay back a maximum total of $8,000 on top of the cost of the loan. However, the money is owed earlier than the other loan. Money is owed each year instead of waiting the full 3 years for payback. Since Fresh Spring is currently low on cash and is looking to make big investments in other areas, it is riskier to be owing money so soon in the process. For these reasons, the first option of the $50,000 loan with $60,000 due in 3 years is the better option strategically for the company.
As for the effect on our accounting equation for a $50,000 loan with a $60,000 due in the next 3 years, it would lead to an increase in our assets, an increase in our liabilities, and also no change in our equity. Our working capital will instantly be affected because of the increase in cash by 50,000, but will immediately go down in 2024 when that time span goes out and we have to pay the $60,000 in cash. As for our net income, it's only affected by the interest, and the interest being 10,000 will mean that it will be affected in 2024. That leaves us with a large percent increase in our working capital, which lets us to do so much in that time span. And the decrease in the working capital and our net income that happens in 2024 is substantial, but the company is still very viable and surviving in that time span, and but that is only based on this liability improvement. Although it is substantial, it shows that our company can survive from this 3-year investment. And from then on, we can continue to grow and increase our working capital and net income, especially with the changes that we've now made.
The last strategic decision involves an equity transaction. The first option is to sell 25% of the business to potential investor A for a valuation of $40,000. The second option is sell 10% of the business to potential investor B for a valuation of $12,000. The first option gives the company a total valuation of $160,000. This deal values the company higher than the other deal, which only has a total valuation of $120,000. This also brings in more available cash. However, this option means that we are giving up more equity of the company to the investor. The second option puts the valuation at a lower value of $120,000. This brings in less cash, but allows us to keep more equity in the company, holding 90%. Which leaves room for more other potential investors later on as the company grows. This is a good option, but this is not the ideal strategy for Fresh Springs, because having cash on hand now to grow the business in other areas is the priority. For this reason, we will be choosing the first option of 25% of the business to investor A for $40,000.
Our equity investment leads to an increase in our assets, increase in our equity, and no effect on our liabilities, as we will not need to pay this back except with dividends, which does not affect our liabilities or our assets. The working capital will be increasing from 2022 and onwards by that nice $40,000. With that, we're looking at a large 253% increase from 2022 and onwards, which will substantiate with the other two investments that have made, which leaves us in a good position. So we will be able to survive from these 3 investments that we're making, and we'll be able to flourish in the ongoing years to come.
Hello everyone, I'm Anna Malik, and as a CFO for the company Fresh Springs, I shall be presenting the journal entries, the balance sheet information, and the future financial expectations for each of the strategic decisions that we have made out of the three listed decisions regarding the assets and liabilities and the equity transaction. So first of all, I shall be walking you through the journal entries, and the journal entries we have here, they are for the first year starting January 1st, 2021 and ending December 31st, 2021. As we see on the left side column, we have the dates, and then we have the account titles and their explanation and whether it is a debit or a credit. And the journal entries have to follow the notion of the debit and the credit equaling out. So we shall see that the debit, we take loan payable. We went with the strategic decision of taking a loan, and we took a loan out for $50,000. And the $50,000 is a debit that's become an asset, and it is going to be repaid. So we have put it as a loan payable, as a credit as well. And then we went on to rent the warehouse for $12,000, and the warehouse became an asset. So we have the $12,000 showing as a debit, and we have to pay off this amount, so that is showing at a $12,000 credit as well. Again, we had the inventory with the cash that we began our operation with. So we had about $3,000 of cash at hand, which is showing as a debit, and this inventory would definitely be sold off. So it is showing as a credit also of $3,000. And then we would have the shareholder stock. We went with the option of selling 40% of our share equity for $40,000 because we wanted to inject cash into our business, as $40,000 for 25% put our company at a higher valuation. So we had $40,000 going in as our debit. And again, it is going to the shareholder stock, so we are showing this as a credit as well. Again, we did not have any loan fee to pay in the same year, but we had to pay the loan fee, which is applicable after 3 years. In addition to the loan, that was $10,000. So there is a $10,000 debit and for the loan payable, and there is a $10,000 cash also showing on the journal entries. Then we move on to the balance sheet information for each strategic decision that we took. So going on to the 3 strategic decisions that we had, I will start with the assets. As you can see that this is our balance sheet beginning Friday the 1st, 2021, and it shows the assets. And we have the cash there, the cash that we started with, the $3,000, and we took the loan, so that was another $50,000. And then we had the accounts receivable, which were $1,500, and we had an inventory to begin with for about $22,500. So in total, we had $77,000 as our assets. And as we know that the accounting equation is assets, they should equal the liabilities and equity. So we have the liabilities, which are the accounts payable, that's $1,000, and the loans payable, which is $50,000, and the owner's equity, which is the capital stock, that's about $26,000, which we started with. So we see that the equation balances completely, and we have $77,000 on both sides. So we went with one decision. So we take another decision, and the other decision was renting the warehouse. So for now, we start off with the next month when we rent out the warehouse, and we see, because it's after a month that we've paid off the money, so our cash goes down to $41,000. We have the same accounts receivable, and our inventory is the same, and our warehouse, which has become our asset, is about $12,000. So we have a total of $77,000 again. And then we see on the other hand side, for the liabilities and the owner equity, it perfectly balances out. So we have a balanced balance sheet. We do have the loan payable, we do have the accounts payable, and we do have the owner's equity there. After these 2 decisions, we go on to make a decision 3, which is about selling 25% of our stocks for $40,000. So we inject the $40,000 in the shares sold towards our asset side, and that increases the shareholder stock to $40,000. So again, we see that we have a perfect accounting statement, which comes out as $117,000 on the left hand side, which is the asset side, and $117,000, which is on the liability, equity and liability side. Hence, the accounting equation is balanced for the 3 strategic decisions that we have taken. Going on to the income statement, we were told that the revenues for the fiscal year ending 2021 were $35,000, and the net income was $22,000. So we computed the expenses, which included the cost and lesses. They were about $13,000. And then for the year 2022, the projected sales and the growth of the business was estimated at 5 to 7%. So taking out 5 to 7% of the values, we computed the average of $37,100 for the revenue. And then again, using the same ratio that we had for the net income with the expenses, we talked about the costs and expenses being $13,780 and the net income of $23,320. Again, for the year 2023, we did have a net income of $24,720, and the revenues were also soaring because it was a steady growth rate in the market. So looking at the market conditions that we had and the accounting model, we are definitely going ahead with our plan of expanding into urban areas, as there is a market and there is a positive profitability for our program, and we are going to be borrowing from the external investors, creditors, and we will be taking that money and inject cash into our operating income cash flows, so we actually generate more profit, and we will be able to pay off the $10,000 that we have taken on our decisions, and we should be fine after 3 years, and we would be definitely making a business, and this would make our business lucrative to the potential creditors and investors. Thank you.
Hi, I'm Will Akinlade. As a creditor, I care for the liquidity of Fresh Springs. How well are they able to pay off their debts? To calculate this, I have chosen the current ratio and debt ratio. The current ratio for Fresh Springs' capability in paying its current liabilities, and the debt ratio to know how well Fresh Springs can handle its long-term debt. I'm also interested in investing in Fresh Springs, and as such, I have chosen the return on assets and return on equity equations. The return on assets equation shows me if management has earned a reasonable return with the assets under its control. In other words, if Fresh Springs is using its assets effectively to turn a profit. While the return on equity equation helps me identify that the return earned on stockholders' investment only is a good value. So I know that what I'm putting into this investment will be used effectively. First off, the industry standards were very important in my decision to invest in this company. I wanted to know if, in comparison to other companies, I would be getting a good bang for my buck. And clearly, as you can see, in every single equation, this company, Fresh Springs, was able to surpass the industry norm. Prior to the company changes in my investment, we can clearly see that Fresh Springs has a current ratio of 27, which surpasses the industry norm by about 2,000%. It has a quick ratio of 4.5, which is 400% greater than the industry norm. A debt ratio of 0.037, which is vastly greater than the industry norm. And in terms of measures of profitability, its return on equity was 85%, which is 4 times greater than the great level of an industry norm. And its return on assets was 31%, which is way better than a great rating on the industry norm. After my investment and their changes to the company, they maintain a solid state in each aspect. You have the current ratio at 1.92, which is in between the industry norm for current ratios. You have a quick ratio of 1.35, which is higher than the industry norm for a quick ratio. You have a debt ratio of 0.52, which is on the lower end of the industry norm, but is still pretty good. And you have a return on equity and return on assets of 55%, which is way better than the industry norm, and 15%, which is in between the industry norm for a return on assets. From looking through the financial ratios, I've been able to find that Fresh Springs has been and will still be liquid from 2021 to 2024. The company in 2021 was looking at very high profitability and long-term debt-paying capability. Although those values have decreased by such a high amount so quickly, I still plan on investing due to the company being in such excess of profit in 2020. If they stayed complacent, it would seem that they would eventually fall due to the change in the market. It's great to see them looking at the long term and pushing for growth. It is also reassuring to see that with such big change, they still manage to stay liquid and capable in their debt repayment.
In conclusion, the best strategies for Fresh Springs are to use loans and equity transactions to rent a factory in a new location. This aligns with the goals of expanding the market, and then Fresh Springs can invest in more inventory to increase sales.